Hey everyone, welcome back to the channel. Today we're diving into a topic that you might have heard of but might not fully understand: internal rate of return, or IRR. If you're into investing, business, or even just curious about financial analysis, understanding IRR is super important. So what exactly is IRR and why should you care? Don't worry, by the end of this video, you'll know exactly what IRR is, why it's such a big deal in finance, and how you can use it to make better investment decisions. Let's break it down and make it simple. All right, let's start by explaining IRR in the simplest way possible. Imagine you're considering investing in something, a project, a business idea, a rental property, whatever it may be. You want to know, how good of an investment is this really? The IRR is one of the key numbers that can answer that question. In basic terms, IRR tells you the rate at which your investment's value grows over time. It helps you figure out if the investment is likely to make you money and how much money that could be. Now, let's simplify that further. When you make an investment, you usually spend money up front and then you expect to get money back later through earnings, profits, or savings. IRR helps you understand how quickly your money is growing from that investment. Here's the key point. If the IRR is high, it means that the investment is expected to make you a good return and your money will grow quickly. If the IRR is low, it means the investment might not be so great and the return could be slow. Okay, now that we know what IRR is, let's talk about why it's important. One of the main reasons why IRR is useful is because it allows you to compare different investments. For example, let's say you have two investment options. One offers an IRR of 5% and the other offers 10%. The higher IRR means the second option is expected to give you better returns on your money over time. So IRR makes it easier to figure out which investment will be more profitable. Think of IRR like the interest rate that your investment is earning. If your bank account offers you 2% interest, you know how much your money will grow, right? IRR works in a similar way. It's the rate of return you can expect from your investment. IRR helps you see how profitable an investment will be in the long run. If you're looking at a new business or a rental property, the IRR can help you understand if it's likely to generate profits at a rate that makes it worth your time and money. If you don't have a good IRR, that might mean the investment isn't worth pursuing. Investors and business owners use IRR to decide whether or not a project is worth going forward with. If the IRR is higher than the expected returns from other investment opportunities or the cost of borrowing money, it's usually a good sign that the project is worth pursuing. If it's too low, they might decide to look for something else. Here's a good way to think about it. Imagine you're planting a tree. You put a seed in the ground and water it, hoping it will grow. The seed you plant today is your initial investment, the money you put up front. The tree that grows over time is the return on your investment. The IRR is like the speed at which your tree grows. If it's growing fast, high IRR, you're happy because your money is working hard for you. If it's growing slowly, low IRR, you might think, this tree isn't growing as fast as I expected. It's the same with investments. The higher the IRR, the quicker your money grows. A high IRR means your investment is earning a lot of profit in a shorter time. So how can you use IRR in real life? Let's say you're trying to decide whether or not to invest in a new business, or maybe you're looking at a real estate property. To calculate IRR, you first need to estimate how much money your investment will make in the future. For example, if you're buying a rental property, you'll want to know how much rent you can charge and how much profit the property is expected to make each year. Once you have those numbers, you can calculate the IRR and see how your investment compares to others. If you have multiple options, IRR will show you which one has the potential to bring you the highest return. This is key when choosing between different investments. Just like with any financial metric, you can't rely on IRR alone. It's important to keep in mind that IRR doesn't take into account risk. For example, an investment with a very high IRR might look great, but if it's extremely risky, that's something you should consider before jumping in. So use IRR as a guide, but always weigh it against the risks involved. Sometimes you'll come across an investment with a negative IRR or one that's just lower than you'd like. This usually means that the investment isn't generating enough profit to make up for your initial cost, and it's a sign that the project might not be worth it. For example, let's say you invest $10,000 in a business, but after a few years, you find that the multiple options, IRR will show you which one has the potential to bring you the highest return. This is key when choosing between different investments. Just like with any financial metric, you can't rely on IRR alone. It's important to keep in mind that IRR doesn't take into account risk. For example, an investment with a very high IRR might look great, but if it's extremely risky, that's something you should consider before jumping in. So use IRR as a guide, but always weigh it against the risks involved. Sometimes you'll come across an investment with a negative IRR or one that's just lower than you'd like. This usually means that the investment isn't generating enough profit to make up for your initial cost, and it's a sign that the project might not be worth it. For example, let's say you invest $10,000 in a business, but after a few years, you find that the business isn't making enough money to cover your initial investment. This would result in a negative IRR because the money you put in isn't coming back to you at a profitable rate. If the IRR is low, that means the return on investment isn't very attractive compared to other opportunities. For example, if you're looking at two properties, one with a 4% IRR and another with 10%, the second one is likely a much better choice for your investment. Let's bring this to life with a simple example. Suppose you invest $5,000 in a rental property. After the first year, you receive $500 in rental income, and after the second year, you make another $600. By the third year, you sell the property for $6,000. So you started with $5,000, and after 3 years, you made a total of $6,100. Now, to calculate the IRR, we would figure out what interest rate would make the total return equal to the initial investment. This helps us understand how much growth our money has achieved over the 3 years. If the IRR is 8%, that means your investment grew by 8% per year, and it helps you see the profitability of the project. So now you know that IRR is a super useful tool for understanding the potential profitability of any investment. It helps you figure out how fast your money is growing and whether an investment is worth your time and money. It's especially important when comparing multiple investment opportunities because it gives you a clear picture of what each option might yield over time. Just remember, while IRR is a great guide, you also need to consider the risks involved and use it alongside other financial metrics when making investment decisions. And if you're ever in doubt, it's always a good idea to consult with a financial advisor who can help you navigate these decisions. I hope this video helped you understand what IRR is and how you can use it for your investments. If you found this helpful, make sure to like, share, and subscribe for more content on personal finance and investing. Thanks for watching, and I'll see you in the next video.